Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, February 3rd, 2024. I hope you're doing well. Thank you so much for coming and visiting me for my weekend review podcast. In this podcast, we're going to talk about a lot of things, but the format is as follows. First of all, we are going to do this legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily and on the weekly charts. We're going to talk about when I entered the trade, why I entered the trade, what was the setup, what was the thinking, what was the strategy, and then most important, how I am going to manage the trade going forward, whether it goes my way or against me. It's very important in trading that you have a process and you have if-then statements. If the price does this, then I'm going to do this. If it does that, then I'm going to do this. You really need a process in trading. I've been trading for over 28 years, and the more I trade, the more I realize how important it is that you have a plan. It doesn't mean that the trade's going to work out for you every time, but it's important that you know what you are going to do. You can't control the market, but you can control what you do, and therefore you need that plan. It's very important to be patient, wait for a setup that has multiple confluences, position size based upon your account value and the volatility of the current market. Place that emergency stop, place that end of day stop, take partial profits if it starts moving your way. Once it gets to a certain level above, tighten up that stop and know the significant resistance levels above you. And this is what I will talk about with you today as we go through my trades. So I have trades on the daily and the weekly. I sold a lot of my positions last week because my stops were hit, but we do have a few positions here. After we go through the trades, we are going to do a little bit, we're going to talk a little bit about trader psychology. Always the most important skill in trading, everyone, is the ability to follow that plan I was just talking about. That is a skill. Patience is a skill. Following your plan is a skill, and that all comes down to trader psychology. So we'll talk a little bit about that. It's always helpful for me to teach this and talk about it, and I hope it's going to be helpful for you as well. After that, I have gone down through my master watch list, both on the daily time frames and the weekly time frames, and I have identified some potential trades that I will be interested in possibly next week. They're not at the levels where I need them to be yet, but the key is, for me anyway, is on the weekends, go through my charts, look for the levels and say, okay, if next week, if they get to this level, then I will consider taking them. Let the trade come to you. Let the trade come to your level, a key level where you basically think that some buyers are going to be coming in. 200-day moving average, 250, 330 RSI. You don't know that they're coming in there, but a lot of the time at those levels, buyers come in there, wait for it to get to that level, position size, and if you take the trade, know exactly where you're going to get out and what that process is going to be. So we'll go down through, like I said, I've marked them both on the dailies and the weeklies, and there's some good ones. There's actually some really good ones. So that is the plan for today. I hope it's going to be helpful for you. If you like anything during the podcast, if you find it valuable, I would really appreciate it if you would hit the thumbs up button and or subscribe. It really helps out the channel. And so let's get started. Let's get this U.S. legal disclaimer out of the way, and we will start. We'll start right at it as soon as it's done. Hang in there for about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started. So, like I said, I had a lot of positions last week. I got out of the majority of them on the dailies because they hit my stop. So, we have a couple. So, this one will be pretty quick here. Let's start with Disney. Disney was a very good trade that I took all the way back here on the January 11th. Great trade, and it's a great illustration. It's a great teaching moment of what I just mentioned before: waiting for the stock or the market that you're trading to come down to the level that you're interested in. I remember talking about Disney on the podcast way up here in these levels, and I said, if we get to the 200 day, I will consider taking the trade. If it doesn't get there, I'm not going to take the trade. So we went down, got very close, moved back up, and like I said, a week in advance, I said, look, if it gets to this level, I will potentially get in the trade. And that's exactly what it did. We did an intraday rejection of the 200-day moving average, meaning during the day, it got to the 200-day, it went below it, and then closed back above. So at this point, what I did was I position sized correctly, and then after I position size, I do two things. I place my emergency stop, which is the red line here. This is exactly 2 ATRs below my entry. And then my end of day stop is simply a close below the 200 day, giving me a very, very good risk to reward ratio if I'm wrong. I have the orange line up here. This is my trailing stop level. This is 1.5 ATRs above my entry. If and when I get to this 1.5 ATR level, then I tighten up my stop and I go into what is called trailing stop mode, which just means that once I reach trailing stop, if I then have a close below a previous bar's low, I will get out of half the position. Well, this never happened. This just went straight on up. So again, the reason I took the trade, intraday rejection of the 200-day moving average. I got long 89.52. I position sized correctly. I placed my emergency stop 2 ATRs below, my end of day stops closed below the 200, and then I have my trailing stop level. These are all defensive moves. Then I also play offense. Whenever the market I'm trading moves up the value of 0.45 ATRs, right now it's 84 cents, from the previous bar's close, I will take a 10% of however many shares I have remaining. So I got long here at 89.52. Next day moved up. It moved up enough for me to take one profit target, or 10% of the trade-off. The next day moved up again strongly. I hit 3 profit targets on that particular day, and I got to trailing stop mode. And all that means is now, in the future, if I get a close below a previous bar's low, I will get out of half. Never happened. Just continued up, took more profits. Continued up, took more profits. Continued up, took more profits. We had some sideways motion. Moved up here, took some profits. Moved up here, took some profits. So this has just gone straight up from when I bought it, with a very good risk to reward ratio. Now, we are at a 60, we did get to a 65 RSI level, and that's a key level for me in my rules, because now in the future, if I have a close below this 5 EMA, I will get completely out of the trade. Conversely, if we go up and we reject the 70 RSI level, I will sell half of the shares that I have remaining. And then after it rejects the 70 RSI, if I get a close below a previous bar's low, I will get out of the entire position. Now, you might be thinking, this sounds complicated. There's all sorts of rules. And yeah, there are. I do have a lot of rules, and every single rule I have, there is a reason for. I've been trading for 28 years as a professional trader, and I have developed these rules because they are important. And just if you would like to learn these rules, if you would like to learn with me, I do teach a private one-on-one course in the evening time via Skype. I think the best way to learn anything is one-on-one with an instructor, and that's why I format these lessons this way. The course is 15 hours, 5 sessions. Each session is 3 hours, and I teach you step by step all 5 of the different trading strategies that I use. I have taught people from all over the world, from absolute beginners all the way up to the hedge fund level, and everywhere in between. So if you are interested in learning to trade like I trade, and you would like a good teacher, which I think I am, just send me an email. We can get the conversation started, and I'll talk a little bit more about this at the end of the podcast. So, anyway, rejection of the 200-day moving average. We've just moved straight up. I wish all trades were this easy, and they're not. They're really not. But this one, fortunately, has been very profitable and a great trade. And this particular trade, with the remaining shares that I have, up 7.86%. We do have earnings coming up on the 7th of February, so I will exit my Disney shares before earnings. I never hold through earnings ever. I really don't. So, holding through earnings, you can make a lot of money quickly, but you can also lose a lot of money quickly. And in trading, your first and foremost, your first responsibility is conserving capital, not making capital. So, and holding through earnings is a good way to lose money quickly. So that's why I have a policy where I always get out of earnings. But nonetheless, good example of a deep dip buy, rejection of the 200-day moving average, just move straight on up here. And if we do close below the 5 EMA, I will get out to the upside. If we reject the 70 RSI, I'll get out of half, and then get out of the remaining if I get a close below a previous bar's low after rejecting the 70 RSI. So there's Disney. And UNH. All right. UNH I did buy on Thursday, the 1st of February. Why? Well, look, here we go. This is another deep dip buy strategy. Here's the 200-day moving average. This is a key level. I was talking about waiting for the price to come down and rejecting a key level. Well, that's why. So the previous day on the 31st, it closed back above, but I decided not to buy it there because it was a little extended over the 200, and I thought, okay, I'll wait. If the next day comes back down, gives me a little bit reward ratio, I will enter. And you can see it bounced right at the 200-day. It's closer to the 200 than the previous day. So I did get long at 506.57. I position size by taking 1% of my capital, dividing it by the 2 ATR. That shows you how many shares that I'm going to buy. And then I place my emergency stop, exactly the value of the 2 ATR below my entry. If it gets there, Monday, if it gets there, I immediately get out. I'll lose 1% of my capital, but that only happens 5% of the time. 95% of the time, if you have a loss with this strategy, with the emergency stops and then end-of-day stops, it's going to be a very much smaller loss. And so in the future here, if we close below the 200-day, I will simply get out of the trade. Orange line up here, my trailing stop level. Once I get to the trailing stop level, doesn't mean I do anything. It just means I'm in trailing stop mode, or in other words, now going forward, if I have a close below a previous bar's low, I will get out of half the position. So got in this on Thursday, 506.56, up a little bit, better than nothing, but only in the trade one day, up 0.76%, which is not bad. All right, that's it on the dailies. Let's head over. I mean, last week I had like 9. So feels like I don't have any trades, but I do. All right, XLF. All right, for those of you who've been watching this, I apologize because I have been in this trade so long. I've talked about it so many times. I just want to get out of this trade. But it's a good example. It's a good example of a deep dip buy on the weekly. I have been in this trade since the 24th of March of last year, getting close to a year. It's a good example, though, of a deep dip buy. Here's the 250-week moving average on that particular week. You can see I almost bought the low. Why? Because during the week, it touched or went slightly below the 250-day, closed back above. Okay, at the time that I took this trade, the news was horrible. We were, falling into the Great Depression. It's important that you follow what's happening on the signals, the technical signals, not the news. And the technical signal was that we rejected the 250-week moving average. I got long here, 30.71. I position size. I placed my emergency stop 2 ATRs below. My end of week stop is just simply a close below this 250-week moving average. I placed my 1.5 trailing stop level up here. And As it moves up, if it moves up the value of 0.45 ATRs on that particular time frame, I take partial profits. The next week, it went up strongly. I took some profits. Next week, moved sideways, nothing. Next week, moved up again. Took a couple profit targets and got to trailing stop mode. Now, if I have a close below a previous bar's low, I simply get out. That did not happen until here on June 23rd. I sold half the position for a gain of 6.4%. Then we had another over a month movement up where I took partial profits, partial profits, partial profits. And then we had this big downturn, almost got me out of the trade here. It almost closed below the 250-day moving average. It did not quite yet. It kept me in the trade, and we've just gone straight up from here. Took lots of profit targets on that week. Couple profit targets here, one profit target here, two profit targets here. I'm at a 65 RSI level. Well, actually, I'm at 72.98. So right now, if we have any down move, I'll be out of the trade, thankfully. I'm not joking. I mean, I'm making money on it for sure, but just tired of this trade because it's been over a year. I shouldn't complain. I'm not complaining, but um, I'm just looking for a new trade to talk about for you guys, right? So anyway, we're at 72.98 RSI. If we close below the 70 RSI, we'll get out of half. But this 5 EMA is in play now. If we just simply close below the 5 EMA, I'll just be completely out of the trade. And this particular trade doing very well. The remaining shares up 21.6%. All right, and then last but not least, Johnson and Johnson. All right. I did get long Johnson and Johnson back here on the 15th of December. Why? Well, I was looking for a confluence of signals and I got them. Here is the 200-week moving average, the black line. We closed above it. We came back down and we tested it. During the week, we went under the 200 and then we closed above the 200. There were no more sellers on that week below the 200-day moving average. We also had a V1. V1 consists of two bars, bar 1, bar 2. Bar 2 went below bar 1's low, closed above bar 1's close. That is a V1. V1s, V2s are a big part of my trading. If you'd like to learn more about them, you can go to my YouTube channel in the lessons playlist, V1s, V2s. Go check it out. It's free video, and V1s, V2s are a big part of my trading, and they're very helpful with anything you do in trading. So go and check it out. So that was the entry, the weekly rejection of the 200 plus the V1. I entered here 154.27. I placed my emergency stop 2 ATRs below. My end of week stops are closed below the 200-day moving average. I placed my trailing stop level 1.5 ATRs above. If it moves up, I take profits. Next week moved up, not enough to take profits. Next week moved up, not enough to take profits. Next week was a nice big up bar, did take some profits. Next week up, hit my trailing stop level. Now all that means is if I have a close below a previous bar's low, I will get out of half. Last week, we did close below the previous bar's low, and I did get out of half for approximately 3.35% profit. So now I have a half position, and my end of week stop going forward will simply be a close below this 200. So the remaining shares that I have now on Johnson & Johnson, up about 1.57%. So real quick recap on the dailies. Disney up 7.86%, UNH up 0.76%, XLF up 21.16%, and J&J up 1.57%. So that's it. Short and sweet, not a lot of positions there. But like I said, we will be looking for some new positions that I'll be looking for next week. Okay, let's talk a little bit about trader psychology before we get on to next week's trades. All right, when I saw this on Facebook or Twitter or wherever I stole this from John C. Maxwell, I really like this because This is applicable both to trading and to life. So let's talk about it from a trading perspective first. Okay. You will never change your life until you change something you do daily. The secret to your success is found in your daily routine. So, in trading, how is this applicable? If you're having issues trading, you're going to have to change something, right? You have to change your routine, your daily routine. And I don't know you, but I can already tell you if you are having issues with trading, it is probably because one, you're not being patient enough for the price to get to a supportive level. Two, if you have a loss, you are probably holding on to it too long. Three, if you have a gain, you're probably getting it out of it too quickly. That's really what it comes down to. Oh, and I would say four, your position size is probably too large. The keys to trading is position sizing correctly, getting out quick, being patient, waiting for the market to get to a supportive level, being patient with your winners, being very impatient with your losers. Most traders do the opposite. They stay in a losing trade too long. They get out of a winning trade too quickly. They're not patient enough to get uh, to to wait for the market to get to the level that they want. And number four, you're probably position sizing too large. Honestly, everyone, this is what it comes down to. And here, you will never change your life until you change something you do daily. Let's just replace life with trading results. You will never change your trading results until you change something you do daily. The secret to your success is found in your daily routine. Everyone, if you're having issues with trading, if you're not doing as well as you're trading, be more patient. Have a process that keeps you in your winning trades longer. Have a process that gets you out of your losing trades quicker and position size correctly. That's honestly, that's what trading comes down to. And if I can help you with trading, like I said, I teach private one-on-one lessons. If you need help with this, just contact me. But whether you learn it from me or whether you learn it from someone else, those are the four important keys of trading right there. And from a life perspective, if you need something to change into your life, you need to change something that you do. Get up earlier, do more things. I don't know if you're in sales, make more calls, do something. But whether it's trading or life, if you want a change, you have to change something in your life. One thing might do it. Several things might do it, but when it comes to trading, be more patient, wait for your entries, get out of your losers quicker, stay in your winners longer, and position size correctly. So thank you, John C. Maxwell. Appreciate this. I think this is a very good post, very relevant to just life in general, and also to trading. So anyway, I hope you found that helpful. And now let's get on to next week's potential trades. Now, these trades are not going to be where they need to be yet. And that comes down to what I just mentioned. Part of the keys to trading is to be more patient and wait for those levels, wait for the price to get to those levels. Okay, look at Apple. Apple had their earnings were not great. Look how Thursday we closed here and then gapped down 7 points. And then we rallied right off the low. Is this a legitimate entry the way that I trade? It is. It's an intraday rejection of the 200-day moving average, but there's some nuances to this. If I were to buy this here, my risk reward ratio is not all that great. And who knows, it might just take off. I don't know, and I'll miss the trade. But the 200-day moving average is the key level. Yes, you could have bought above it. What I'm waiting for is a better risk to reward ratio. I'm waiting for Apple to pull back closer to this 200-day moving average, the black line. Like I said, it might just take off and go up. I kind of doubt it, but what do I know, right? It can do anything it's going to do. But the other thing that I like is look at this bar from the low to the high. I drew this line, the green line here. This is halfway. From a Fibonacci standpoint, half waves of big up bars are very important levels. So if you have a big up bar and you come back to halfway, there's some inherent support in there as well. And that halfway just happens to dovetail with this 200-day moving average. Does that make sense? So that's what I'm looking for next week. I'm just looking for a pullback, a better entry, ideally right at halfway, just right above the 200-day moving average. That would make a lot of sense. Doesn't mean it has to hold and go up from there, but if it goes down, then I'm closer to my stop. That makes sense? So that's what I'm looking for sometime next week, is a pullback closer to halfway and or some type of bounce or intraday rejection of the 200-day moving average, or a close under, close over 200-day moving average that gives me a better risk to reward ratio, or in other words, it's closer to the 200-day moving average. So I'd really like to get into Apple here. For those of you that follow the channel, I got into Apple with a great trade here on the 17th of January. Why? Just because this is intraday rejection of the 200. Got long here at about 182, moved up, took profits, moved up, took profits, moved up, took profits. And then here, I got out of half of my position because it got to trailing stop level and then closed below a previous bar's close. I got out of half here. And then here on the 26th, I got out because it closed below the 5 EMA. But you see how those rules really worked well for me? I was patient. I waited for the 200. I scaled out. I scaled out. I scaled out. My process told me to get out of half here and all of it here. So it was a great trade, obviously, because it went all the way back down. So I'd love to get back into Apple. I really would. I just need to pull back to the 200-day moving average. And by the way, everyone, what do I have? 7 symbols here. It is possible that all of these symbols could trigger all on the same day. So would I take all 7? Absolutely not. I have a rule where I only take, no matter how many stocks trigger in a day, I only take the best one. And what makes up the best trade? Many different things. Which one has the most confluences of signals? Which one has the best risk to reward ratio? Which one looks best on multiple time frames? Which one out of all of them had the best market, the relative market strength compared to the rest of the market, whether I'm long or short? So one of my favorite things to do is when I have a handful of stocks is to narrow them down to the best trade. And again, this is what I teach in my one-on-one course. I mean, it's really the fine nuances. Just because something goes under 200, over 200, yeah, okay, better than nothing. But to really dial in and to really improve your profitability is looking at many different things: the confluences, the multiple time frames, the risk to reward, the relative strength. And again, this is what I teach in my one-on-one. So if you're interested in those, please reach out to me. My email's in the link in the description. So Apple, just being patient, waiting for a pullback to the 200-day moving average and or halfway. I'd be happy to buy it at halfway there as well. Carnival Cruise Lines. All right. Well, a couple different options here. The easy one is right here where I have the blue box. 200-day moving average seems a long ways away from there, right? Fine. I don't care. If it gets there, okay, I'll consider taking the trade. If it doesn't get there, I just won't take the trade. But the gray line here is the negative third ATR channel. 92% of prices tend to bounce at the negative third ATR channel. See how we've lined up the negative third ATR channel right with the 200-day moving average? That's why I have the blue box here. This would be an excellent risk to reward ratio for this trade. It doesn't mean it would work, but you have a very structured trade. Your line in the sand is the 200-day moving average. Great place. I don't know if it will get there. Probably not. But if it does, great place from a risk to reward structure for a trade at a key moving average. The other option here would be a higher low V1 or V2 in the value zone. The rules for a higher low V1, V2 is first we have to close below the value zone. The value zone is this green line, anywhere in between. Did we close below? We certainly did. Did we rally into the value zone? Yes, we did. Now I am just waiting for a pullback and a V1 or V2 that closes in the value zone with the low being higher than this low. If you'd like to learn more about those, again, go to my YouTube channel, look for the V1, V2 lesson. So two options on CCL. First, a deep dip buy at the 200-day moving average and the negative third ATR channel would offer a very good risk to reward ratio. Alternatively, next week, if we come down and create a V1 or a V2 entry, be an excellent place to buy as well. And again, go to my YouTube channel, look for V1s, V2s. You'll learn about higher, low V1s, V2s. Okay, so that's Carnival, CCL, Etsy. Etsy is very interesting here. You can see that I drew this blue box here. What is that blue box? Well, a couple things. Very strong entry here. This is what's called the fair value gap, and it's also the top of an order block. This is ICT material. You can learn more about ICT on YouTube. It's very, very good material, but let me kind of show you in general what happened here. Here we had a low. Here we took out that low. Then this big bar up took out this high. Why does that matter? Well, this changed market structure from the downtrend to an uptrend by taking out this swing high. Okay, so now we're in an uptrend, is basically what that's saying. So the key is when you change directions in an uptrend, you want to buy pullbacks. Well, there's something called the fair value gap, which right now is between approximately 70.70 to 69.40. This would be a very, very interesting place to buy because Thursday we changed market structure to the upside, and the key is buy dips in an uptrend. Well, this changed the structure of the market to an uptrend, therefore waiting to buy a dip. In addition to that, we have the top of an order block. An order block is this big down move before we change market structure. So 69.40 would be an excellent place for me to get long Etsy here. I don't know if it's going to get there. You can see it was up 4% on Friday as well. But if it does get back to this level, not only were you in a fair value gap, we're also at the top of an order block. And again, this is something I teach in my classes as well. I may consider selling puts down to 69.40 next week. I think it would offer a very good premium selling opportunity because this level here, it should not go below this level. I don't know if it will get there, but a way for me to capitalize on this, if it doesn't get there, is to sell puts down there because I think it's very unlikely we are going to get down there. So it might be a good put selling premium opportunity for me. So, but for the purposes of this podcast, if we get back down into this fair value gap between 70.70 and 69.40, I will consider getting long. My end of day stop would just be a close below the low of this bottom bar or this order block. Intel. All right, well, Intel did not have a good showing with its earnings, obviously, but it is getting to some interesting locations here. We're at 35.72 RSI, so I would be looking for a under 30, over 30 as a possible entry point. You know, a really strong confluence with a 30 RSI is the 200-day moving average, 250, 300, but also a moving average that we don't talk a lot about when it coincides with the 30 RSI is the 100-day moving average. This is the red line here. So if it's going to depend how long it takes to get down there from the RSI level, but next week, if we get near the 100-day moving average at the same time rejecting a 30 RSI, that would be my confluence of signals to buy. All right, let's get to the Russell IWM. All right. Couple things here on IWM. All the way down here at the 200 would obviously be a very good place to take a look at buying that. I don't know if it's going to get there, but What it's also formatting up for right now is a potential return to value. We talked about higher low V1s, V2s. Return to value V1s, V2s are an excellent setup. And it is something that I teach again in my one-on-one courses. We the green line, the top, the bottom green line is the value zone. The first requirement is that we need to close above the value zone. We need to come into the value zone. Then we need 2 bars of sideways motion. We have that now. Closed above, came in, 2 bars of sideways motion. In the future now next week, if I can get a V1 or a V2, I would consider getting long IWM, not just because it's a V1 or a V2, but more specifically because we were above the value zone, we came into the value zone, moving sideways. Now a V1, V2 would make up a very, very good trade. If it does that, I don't know what's going to do that. Nike. Okay, Nike, we were talking about higher low V1s, V2s. We closed below the value zone. We came back into the value zone. We have pulled back. MACD is green. This is formatting for a potential V2, but Monday, only Monday. Because here is bar 1, bar 2 went below bar 1's low, bar 3, if we close above bar 1's close, 101.76. So that is what I'm looking for. Monday only is a close above 101.76. That would be a higher low V1 from this low here. And then last but not least, VIX. VIX is quite interesting here. Markets are making new highs. VIX is not making new lows. That should tell you something. And I was talking to you about higher low V1s, V2s. VIX could potentially do this next week. We are certainly below the value zone. We moved into the value zone. Now, if we can get a pullback, giving us a higher low V1 or V2, that would be an excellent spot to enter for a higher low V1 or V2. VIX not making new lows while the market's not making while the market is making new highs is very suspicious to me, everyone. I've got to tell you. That's why I'm quite concerned about the market being near at least a short-term top because of what VIX is telling us. But from a trading perspective on VIX, we were below the value zone. We rallied into the value zone. We need a pullback and a higher low V1, V2. So real quick, again, I'm looking for a recap. I'm looking for Apple to come back, test halfway of Friday's big up bar or a rejection of the 200. Carnival, I'm looking for either two things, a pullback to the 200-day moving average or a higher low V1 or V2 in the value zone. Etsy, looking for a pullback between 70.70 and 69.40 for a pullback into the fair value gap. Intel, looking for move down to the 200-day moving average or a 30 RSI 100-day moving average confluence. Russell 2000, looking for a pullback to the 200 or a return to value sideways motion V1, V2. Nike, looking for Monday only, a close above 101.76 for a higher low V2. And again, VIX, looking for a pullback, higher low V1 or V2. All right, so those are the dailies. Let's get on to the weeklies. Hey, by the way, I'm still in Santa Marta, Colombia. I just really, really love it down here. I've extended my stay like 3 times, but if you haven't been to Santa Marta, I would highly recommend it because it is a wonderful, wonderful place. Just warm weather, very friendly people, very, very nice. I really enjoyed my stay. Okay, on weeklies, I have Boeing. Boeing, of course, had the issues with some of the bolts on their planes. Looking below, where is that key level that makes sense to potentially enter a trade? Well, it's the 200-week moving average. You can see the black line here. I've highlighted this area in blue. If we get down, if and only if we come back down and we test this 200-day moving average, either a bounce, an intraday rejection, a close under, close over, I would consider buyers should be coming in here. a lot of people won't be buying Boeing until it gets there. And then when it does get there, then they buy it. Well, that's the self-fulfilling prophecy of moving averages. So looking for some type of bounce or intra-week rejection on Boeing next week. Russell 2000, IWM. 200-day moving average is in view. If we have a pullback, we could certainly get there. That would be an interesting place to think about getting long IWM. You can see last time we closed under, closed over, it held, we came back down, we got right there, Magico. We bounced right at the 200 week, and then it moved up from there. It certainly could get down here to the 200 again, and that's where I'd be looking. So IWM, some type of bounce and or intra-week rejection of the 200 IWM, I would consider getting long. Pfizer, all right, well, I've been talking about Pfizer for weeks. I said, look, if we get to a 30 RSI, I would consider buying Pfizer on the weekly. Here we went under 30, over 30. That has held so far, but it's not there yet. It's 33.40. So it certainly next week could have under a intra-week rejection of the 30 RSI. What's interesting here is we're starting to form a double bottom. Well, not quite. It's not a double bottom yet, but I can just tell from experience that if we do get down to test this low, that we will not have as deep of red MACD bars here, showing that we're running out of selling momentum. A double bottom bullish divergence, double bottom bullish MACD divergence. At the same time, we have an intraday, or I'm sorry, intra-week rejection of the 30 RSI would be excellent buying opportunity. So again, be patient. For me, I'm being very patient, waiting for Pfizer to potentially reject the 30 RSI on the weekly, and also in light. And it may not be next week. It may be the week after that or the week after that. But if it happens next week, a rejection 30 RSI, I will certainly consider taking it. Unity Software. Okay, I talked a little bit about return to value V1s, V2s. These work on any time frame. Here's the top of the value zone, the green line. We closed above it. We pull back in it. We need sideways motion. Do we have it? Yes, we do. We made a low. Okay, now we have sideways motion. Next week only, if we close above 33.11, I will consider getting long Unity Software with a return to the value zone, sideways motion V2. UNG, well, UNG went straight up and then straight on down. What am I looking for? Currently, we're at 38.52 RSI. I am looking for a test rejection of the 30 RSI. And I can also tell, look at the low we have here with the deep red MACD bars. If we come and test this low, there will not be any red, at least not next week. Double bottom bullish divergence with a 30 RSI trigger. Same with Pfizer. I can tell that we're going to, if we get here, we'll have a double bottom bullish divergence, MACD divergence. The entry trigger is a 30 RSI. Same with UNG. But the key is it's not there yet. The key is waiting for that 30 RSI rejection. And then VIX. I have been talking about VIX for weeks and weeks and weeks. I'm still waiting for a close over the 30 RSI. Earlier in the week, it was above the 30 RSI. Right now, it's 29.07. We're making lower lows, lower lows. MACD is still green. Long term, I am very bullish on VIX, actually, and long term, I'm kind of bearish on the market. So I watch VIX very, very closely as an indicator of what the market's doing. But if we do finally close above that 30 RSI, I will consider taking the trade. So real quick recap again: Boeing next week looking for rejection of the 200-week moving average. Pfizer looking for a IWM looking for a rejection of the 200-day moving average. Pfizer looking for an intra-week rejection of the 30 RSI in light of the potential double bottom bullish divergence. Unity looking very nice setup. Return to the value zone, sideways motion next week. Unity Software, if it closes above 33.11, I would consider that. natural gas, looking for a rejection of the 30 RSI in conjunction with potential double bottom bullish divergence. And then again, VIX, fairly easy, just looking for a close over the 30 RSI. So again, on the weeklies, they could all trigger the same week. I'm not going to take all of them. I'm only going to take the best one, the one that has the best confluences, combinations of indicators, the one that has the best risk to reward ratio, the one that looks best on multiple time frames, and the one that's strongest from a market relative strength standpoints. Again, that's what I teach in my private one-on-one lessons, and we'll talk a little bit about that. Like I said, if you're interested, please contact me. The course is 15 total hours, 5 sessions. Each session is 3 hours. I teach you all 5 of the different trading approaches that I use. We do a lot of simulation trades. I teach you the strategy. We go through, I ask you a lot of questions, and then we spend time doing simulations. We pick a random chart, we pick a random time frame, and we go through, and you are the one driving. I teach you the lesson, and then after I feel like you have it, then we just go through many different trades, all sorts of different scenarios. And when you're done, you will know this like the back of your hand. Trading is a great skill to learn. You can do it from any place in the world. As I mentioned, I'm in Colombia right now. As long as you have an internet connection, you can trade. But it's important to have a good teacher. It's important to learn from someone that's done this for a long time. And that's been through many different markets. The cost of the course is $1,750, but I'm telling you, it's worth every penny. It's a bargain for what you get. So please reach out to me. Be happy to talk to you and hopefully to teach you and to work with you. If you're not in a financial situation to take the one-on-one course, I have a really good online course available at udemy.com. In that course, I teach you step-by-step how to trade the deep dip buy strategy. I've sold many of those around the world. Very good reviews, very good feedback. And so if you want to start with something maybe a little bit more affordable, that's a great place to do it. And I have the link there. Again, if you enjoyed the podcast today, I would appreciate it if you could hit the thumbs up button. It really does help the channel out, and it's totally free. So if there's something that you found valuable, just give me the thumbs up and we'll be square. And then always like to leave off with, please try to go out and do something nice for another human being today. Please try to go out and do something nice for an animal today. If we all did one nice thing for another human and one nice thing for an animal, the world just obviously would be a better place. So I appreciate you being here, everyone. Thank you for spending your time. I hope you found it valuable. And God willing, I will be back next week. But please be careful in the market. Like I said, I think we are a lot closer to the highs than we are the lows at this point. So get yourself a process, be patient, follow that process. And all right, I guess that's it. All right, have a good week, everyone. And we'll talk to you soon. On the way out here, I have to run the US legal scale. Thank you.
U.S. government requires options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit, No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.